Thank you for joining me for a short video describing the stock valuation model. The valuation tool consists of two valuation models, one being a discounted cash flow valuation and another being a PE valuation. And then we have a blended valuation, which is essentially the blend of the two. To calculate the valuation, all you do is you type in the ticker symbol that you wish to value. In this case, typed in Google, and then in a matter of 15 to 20 seconds, all the financial information is imported into the model from online websites such as Smart Money, Yahoo, and other free websites. You see the model is updating. When the hourglass is done and the name changes, you can see that we've now got everything imported. So if you walk over to the import sheet, you'll see we have an income statement for the last 10 years in there, balance sheet, as well as a cash flow, and then various growth and other PE or other metrics about the stock, and various analyst forecasts are imported as well. So if we go back to the valuation model, up here on the very far left, you would enter the discount rate, and this for companies that are of small cap, or in this case maybe a little more fast growers or more riskier stocks, you put in a 11% minimum hurdle rate, which is your discount rate. For companies such as Walmart or other companies that are very predictable, very consistent growth model or business models, you put in maybe a 9%. And if you're working with a company that's very unpredictable in terms of their financial model, you might want to put something a little higher in there. And these numbers here I'll leave the same, 30% and 15%. All they do is they change some formulas down below, and I'll show those to you in a second. So what we have here is on the left here is the various value drivers. If you go over here real quickly, these are the value drivers. We calculate the net operating profit margin, and this is the values that are imported in, and there's the 10, 5, and 3-year history, average history, and then same for the net investment margin and change in working capital margin. I won't go into detail here on how to calculate those, but along with this model, I have an investment guide that walks you through the process of calculating those various metrics or value drivers, and also points you to some other additional reference material if you want to expand your knowledge and dive a little deeper into it. So for the tax rate, this is essentially, it looks like it's varying somewhere between 33% as an average over 10 years, down most recently down to 21. Let's take the 5-year average as a long enough period to kind of get a good snapshot, especially seeing how it's trending in the down direction. So lower the tax rate, the better here. The PE ratio has been averaging between 13.9 and 56.2, so pretty radical variations over the years in terms of what people are willing to pay for the stock. I typically don't like to go much higher than what the projected growth rate is, so in this case it's 18%. It's currently at 20 is the current PE ratio, so why don't we put in we'll put in 18 as our PE ratio that we're expecting in year 10 to calculate, and that's used along with for the PE valuation model. Net operating profit margin, what you want is a company that is very consistent. This is the biggest value driver in terms of impacting the valuation for the free cash flow model. This is a perfect kind of stock in the sense that it seems very predictable. Let's put in 32.8 as the net profit margin, and this the invested margin, net investment margin. Here, the lower the number, the better. It means it takes less capital to terms to keep the company running. And it's trending down, up. It's kind of going between 6 and 4.2 is the average. Let's put in 4.5. It seems to be consistently as the company's growing to be over the last few years. It's gotten pretty large, and it seems like a pretty good average number to use. And then the working capital. This one has the least impact on the valuation of the stock, but it will vary the price by generally maybe 2 to 3%. So it's not a huge impact to it. So you don't need to be quite so concerned about that one. The growth rate, it's been growing about 24% a year for the last 5 years. Analysts are saying they're predicting about 18% growth this year. Next year about the same, and about the same going out to 5 years. So I typically don't quite go in with their forecast. They tend to be, analysts as a whole tend to be a little too optimistic. So I tend to temper their forecast a little bit. So based upon the value drivers that we just put in, we have basically using the discounted cash flow model, the price comes in at $886 a share, and for the PE valuation, $832 a share, and then blended about $860 a share. It's currently trading at $604 a share. So based on that, we can calculate what our expected rate of return is. So at the current price for discounted free cash flow model, we would expect to get about a 15.3% return, 14.6 for PE, and a blended at about 15. You can change up here your desired rate of return. So let's say I wanted to have, just say 12%. So if I change to 12%, obviously this number down here doesn't change. That's based on its current price. But if you wanted to get 12%, basically you'd buy at anything below $810 a share, or $760 a share, or a blended value of about $785 a share. So you can see that varies up and down based upon your required rate of return. And the net or margin of safety number, that will change this number here. So it's just a quick way to kind of ratchet up or down what you might require for this stock. So in this case, if I want 25% discount from the intrinsic value, which is all that is, let's say I'd be buying it a stock price of $665. Put that back to 30%. That's all I have for you today. If you got some further questions, feel free to drop me a line or send me an email, and I'd be glad to answer them. Hopefully this helps you understand what the valuation model can do for you.